Hi, everyone. Welcome to Financial Fridays with SAANYS and Equitable. Today's topic is life insurance awareness. SAANYS is very excited to offer these sessions in cooperation with our corporate partner, Equitable Advisors. They have been a long-standing presence in New York, and a large portion of their New York client base is built upon the work they do within the public education system. Through Equitable, we SAANYS members can receive competitive insurance rate, a full array of retirement service, a complimentary financial profile for SAANYS members, which we definitely urge you to take advantage of. It's a great benefit for the membership. Joining us today from Equitable is Nick. We'll save questions until the end, or you can put it in the chat and we'll go over them at the end. Our Q&A time is best used for general questions, but know that the Equitable team and Nick is available at any time to answer your personal and confidential questions. And you'll have his contact information also at the end, and other regional Equitable advisors. This video is also, again, being recorded and it will be uploaded to SAANY's YouTube channel. And I would turn it over to Nick.
Perfectly, Shay. Thank you so much. I appreciate it. I'm going to share my screen here in a second. This should be coming through now. So today we're going to talk about life insurance and risk management goals and strategies. So the screen should be sharing right now. If it's not, if somebody could let me know, I would appreciate that. So
That's great.
That's great. Awesome. Thank you. So again, my name is Nick Agulia. I'm one of the regional vice presidents with Equitable Advisors, as well as a certified retirement education specialist, and I work out of our Buffalo office. And today, again, the goal is going to be just to go through, talk a little bit more about life insurance, the importance of it, some risk management strategies, how this all fits into somebody's overall financial plan. And again, at the end, if anybody has any questions, feel free to find them or put them in the chat. Up at the top right of every slide, as well as on the very last slide, there is a QR code. That QR code you are able to, throughout the presentation, take a picture of, and that is a direct link right to my calendar. So if anybody has more personal or one-on-one questions they would like addressed or answered, feel free to use that QR code to set up a time for us to talk more in depth. So diving into the agenda, we're going to talk a little bit more about a balancing act of how do we balance all of our financial goals and obligations. We're going to go through a little bit of an educational piece on different types of life insurance. And then we're going to talk a little bit more about investing in risk management. And again, how does this all tie together? So it can be very, very tough today to juggle evening schedules, maybe for those of us that have kids. I have three myself, senior, freshman, and an eighth grader at Start Point, and it feels like in addition to a financial advisor, I feel like I'm also an Uber driver, running back and forth between soccer and piano and everything else that's going on. So many people are in similar situations. And again, part of the discussion today will help understand or break through the fact that we all have busy lives, but there still are some important components and things we need to make sure that we are addressing. So we'll start talking about the balancing act first. So there's so much to cover, there's so much to talk about. Sometimes it's confusing to know, where do we start? And we're looking at it saying, maybe we have now this beautiful family of ours, or maybe we have dependents who rely on us. Sometimes it's kids who rely on us. For some people, it's grandkids who rely on us. Other people are in a situation now where they're caring for maybe a parent or even a sibling in some cases. So having a financial plan is extremely, extremely important. And a financial plan is simply just a map. It's a map or a plan that's going to help us manage and understand all of our financial obligations. And that goes from everything, including paying bills, to making sure we have some, again, insurance or risk management in place, but also make sure that we're keeping track on saving for the future at the same time. So what are some of the first steps? So one of the first things somebody would do if they bought a house would be generally to think about buying furniture for that house. But really the first thing that you have to do is you have to purchase insurance on that. And in some states, it's optional. In New York State, it is required to have homeowners insurance if you have a mortgage specifically. So, if we're looking at this saying that when we buy a house, the first thing legally and responsibly that most people are going to do is they're going to insure that asset. They're going to insure that house. So when looking at it from the fact of life insurance, one of the things that we need to make sure that we're also taking into consideration is how valuable of an asset we as human beings are we as providers are for our families. So making sure that we're exploring and understanding the options of why we should have life insurance on ourselves, again, is a continued conversation we will have throughout the process today. So here's a provoking thought. Everyone has a plan for life insurance, whether we realize it or not. I'm going to repeat that. Every single person has a plan for insurance, whether they realize it or not. And what I mean by that is the choice to not purchase life insurance, the choice to not have insurance is still a choice. It's a choice to self-insure. And what that means is that if we are self-insuring, we are taking on all of the risks ourselves. We're taking on all of the liability, all of the risks of poor health, of premature passing, the liabilities of asset loss. All of those we take on the burden of personally. So choosing not to have insurance is still a choice to have an insurance plan. It's just a choice to take on all of those risks ourselves, as opposed to passing those risks on or transferring some of that risk over to a third party. I touched upon this slightly, but the single most important asset that somebody is going to have is going to be themselves. And a lot of times, if I ask the question to somebody, what is your biggest asset? A lot of people will say their 403b. Some people will say their spouse's 401k. A lot of times people will say it's my pension. Right? We know how valuable the New York State pension can be. But again, ultimately, the biggest asset somebody has is themselves. It's the ability to earn for yourself and or earn for your family. It's the ability to be able to pass monies on. And upon a premature passing, not only are we losing that income, which is the obvious, we're also losing things that we don't always think about. For instance, premature passing means we could lose our New York State pension. In many cases, if we pass prior to retirement, that New York State pension disappears, goes away, nothing pays out. Now I say that a little embellished. There is a one-time, as I like to call, consolation prize that would pay out in lieu of the pension. But there are hundreds of thousands, and for some people, it's almost millions of dollars that could potentially be left on the table that their family is no longer receiving. We're also at running the risk of premature passing of losing our Social Security. That would no longer pay out. So there's a lot of other incomes and assets that are attached to our lives that if we are here for, awesome. That is everybody's goal, clearly. But if, again, God forbid, something terrible or tragic happens, all of those assets, all of those incomes, all of those future resources that would have trickled down to you, your family, disappears. So I've kind of hopefully hammered home or done a decent job of painting some morbid pictures, unfortunately, of why we need life insurance, or what are some of the factors that we need to take into consideration. Let's get a little bit more into now the educational part of it and talk about different types of life insurance. So there are really two main different types of life insurance that are out there. We have term insurance and we have permanent insurance. And term insurance, like it sounds, is pretty cut and dry. It is a canned product. You can go to an insurance company, whether it be Equitable or another company, and say, I'm very interested in getting a term insurance policy, and I want that policy to cover me for a specific term, a specific period of time. Most commonly, we see people utilize 20-year term insurance policies. From there, we have to decide how much of a death benefit do we want. Meaning, if God forbid we passed, how much money would we want to pay out to our beneficiaries tax-free? So in the example on the screen here, if we did a 20-year policy, we had a $500,000 death benefit. All that means is that as long as we made our premium payment, in this case, the premium or the cost of the insurance, the two words are synonymous here. If the cost of the insurance, the premium is $30 a month, we make that $30 a month payment. And if anything were to happen during that 20-year span, $500,000 would pay out 100% tax-free to our beneficiary. Very inexpensive, very responsible, very easy to accomplish. However, one of the disadvantages of term insurance is the policies only pay out about 2 to 4% of the time. So 2 to 4%, that means that 96 to 98% of the time, these policies just run their course, they expire at the end of the 20 years, and they don't pay out. That's not necessarily a bad thing, right? Because the other side of that coin is that means that we are still alive. It means we outlived the 20-year term. So if you relate this back to auto insurance, nobody calls their auto insurance company after 20 years and says, you know what? I never got into an accident. Turns out I really didn't need the insurance. Can you give me my money back? Right? Say this in jest, right? Kind of silly. Nobody would think to do that. So again, it serves a purpose. Term insurance is meant to be an inexpensive type of insurance to cover you during a specific period of time, arguably during the time period where we need the largest amount of insurance. I like using personal examples. Again, I have three kids that are going to eventually need to go through college, three kids that are probably going to need help getting started in life based off of how expensive everything is, based off of inflation. And without my income, I would be setting them up for either failure or just a very hard start. So having that protection for them, highly beneficial during the years when they need it the most. The second type of insurance is more permanent insurance. And again, you don't have to be a rocket scientist to figure out that permanent means it's going to last you permanently. It's going to last you for the rest of your life. So the way that permanent insurance works is a bit different. So if we're looking at the numbers on the screen so far, right, if we have apples to apples comparison, we have that same $500,000 death benefit. In this case, the two components of permanent insurance are going to be slightly different. The cost of the insurance is going to be still higher than term, but the cost of the insurance is actually going to be lower than the premium that we are paying. So in simpler terms, insurance company says it's going to cost $150 a month to insure you now. But every year as you get older, the cost of insuring you is going to go up. So to prevent you from ever having to pay any more money, the insurance company has you pay a little bit of a higher premium to start the policy off. So in this example here, if someone's paying $300, $150 is going towards the cost of the insurance. The $150 that's extra goes into an investment account or a cash account. That money earns interest and compounds over time. The nice part about having this cash account is that money can eventually be pulled out and used for things prematurely or prior to us passing. One of the biggest knocks on insurance that sometimes people will say is, well, I only benefit from it, or my family only benefits from it if I die. Not with permanent insurance. With permanent insurance, you have the ability to still utilize it while we're alive, and we can utilize it for anything. Some of the more common ones are using it as an emergency reserve account. Life throws us a curveball, we need some money, we can access cash from the account. A lot of times we can structure this to help people pay off a mortgage early, for college savings, maybe retirement income supplements, helping to cover the cost of long-term care. So having the ability to have our insurance, but also be able to invest or grow money in the account along the way to help with various life events or various goals of ours is highly beneficial. Now, going one more step granular, permanent insurance is a generic term. Permanent insurance has different types of subcategories, the most common being whole life or universal life. And this type of insurance generally pays a fixed interest rate. So they say, okay, if we have X amount of dollars in our cash account, every single year it's going to earn X% interest. Or in this case, as an example, 2 to 4% interest. Versus a variable life insurance, money in the cash accounts gets invested just like it would your 403B and or a 401k. Money gets invested into the stock market, into different funds. And realistically, over time, you can see anywhere between 2 to 12% interest on an annual basis. So we have the ability to grow our money more. And for somebody who really likes the idea of having cash accessibility and flexibility, variable life insurance really fit into people's situations a lot of times. So the $1 million question, which, if any, is the right type of insurance for somebody's situation? And at the end of the day, it's a loaded question because it is very, very specific for the individual. It's very specific for the goals that they're looking to accomplish. So the benefit, again, of sitting down with a financial planner, I'll say specifically one who understands the needs and the nuances and the specifications of New York State employees and New York State employees' benefits, that individual can provide you a very in-depth analysis. We can provide you a very in-depth overview as to what options may make the most sense. Switching gears, we're going to talk a little bit more about risk management and long-term care futures. So it is not a secret these days. If anybody's gone through this personally, you can relate. If not, you may have heard stories about this. But risk management can include anything from premature passing to premature disability, all the way to long-term care events, meaning assisted living, at-home care, or skilled nursing facilities like a nursing home. And the cost right now, on average, varies across New York State, but we'll say on average, it can be somewhere around $12,000 to $14,000 per month. $12,000 to $14,000 per month for a long-term care skilled nursing facility. So it can get very, very costly. And those monies, in a lot of cases, are going to be coming from people's assets. Part of having life insurance and a risk management plan and or a long-term care insurance policy, there are a lot of legal documents or legal agreements and insurances that can help to mitigate this risk. And again, not only cover us if we pass prematurely, but also provide protection of our assets or income replacement in the event we needed some sort of more extended, longer term care. So when it comes to managing investment risk now, of maybe retirement accounts or non-retirement accounts, and this can also apply again to our insurance investments. Right? Insurance isn't just insurance. Insurance is also an investing component. Because again, insurance is going to either one, if we're talking about permanent insurance, it's going to have the ability to accumulate assets or an investable amount of money. Or two, if it's term insurance, it has the ability to pay out an asset that eventually could be again reinvested and used to generate income for whomever was left behind. So we talk about the fancy financial buzzword diversification, right? We don't want to put all of our eggs in one basket. We want a variety of different baskets. That means our 403B, That means we absolutely should be saving money into a Roth IRA as well. It means we should have risk management vehicles in place, so on and so forth. Asset allocation, right? Another buzzword. This is taking a look and building out a portfolio for somebody, again, that includes what stocks or mutual funds are we invested in inside of our retirement accounts? What types of insurances do we have in place? What are we investing in maybe inside of those insurance policies? Another buzzword people may be familiar with is dollar cost averaging. Dollar cost averaging means that you are systematically saving money into various places. By far, the most effective strategy to saving money is having a systematic plan. That's why at the end of the year, the district or a financial professional doesn't come up to you and say, hey, we need you to write a check for $5,000 to put into your 403b. First of all, it would drastically reduce the amount of people that actually were able to do that or would want to do that. Therefore, the systematic savings of our per payroll deduction, or our maybe individuals have Roths or different accounts or insurances that are linked to their checking account on a monthly basis. These monthly contributions, these monthly systematic plans help to provide dollar cost averaging. And all that does is it means that you are ensuring that every time you make a contribution, your money is going to work for you at an average price. Simpler terms, if we took all of our money and we had to try to guess when the best time to put it into an insurance policy or put it into a 403b was, in 365 days a year, if you had to guess the one singular best opportunity, we would probably guess wrong, myself included. So having that systematic plan, we are getting an average of the cost every single month of investments, which means we have a greater likelihood to see long-term success. We go through investing 101 now, shifting gears, and investing 101 is not only relevant to investing in your 403b or a Roth IRA or a spouse's 401k. Investing 101 is also relevant when we're talking about putting money inside of life insurance. So historically, there are a few main areas that you can invest money. One being cash. Cash on average earns 0 to 3%. Nick, my savings account right now is earning 4%. Nick, I have a CD at the bank that is getting 5%. Yep. These are the historical averages though, right? We're in an outlier right now that is going to end very, very quickly. As interest rates come down, we know they are coming down. We will start to see interest rates normalize. So right now, maybe we take advantage of it, we enjoy a little bit of higher interest rates, but 0 to 3% has always been historical averages. Cash accounts are going to be things like checking, savings, money markets, CDs. This is your short-term money needed to pay your bills with, needed for emergency funds. The problem with this money, and the problem is when people have too much money in CDs and money markets, we think it's safe, but we're missing the forest through the trees. Because inflation on average runs at 3%. So if everything around you is getting more expensive more rapidly than you're growing your money, you're losing money. You're losing purchasing power, which is not good in the long run. And a lot of people think CDs stand for certificate of deposit. We jokingly say, half jokingly say, they actually stand for certificates of depreciation. Because a CD, a checking, a savings, and money market, those are investments that you can pretty much guarantee you will lose money. You will lose purchasing power specifically every year that you hold those investments. Doesn't mean we shouldn't have them, right? We need to have money to pay our bills. We need to have money in an emergency fund. But we also need to be cognizant that we can't have too much money there. Otherwise, we're going to not be able to keep pace with the long term. If we're looking to take on a little bit more risk, we would look to bonds. Bonds are nothing more than an IOU. You're loaning your money to a government. You're loaning your money to a municipality or a corporation. And those entities are guaranteeing you they are going to pay you back your money that you put in with a specific interest rate along the way. Historically, bonds average about 3 to 5% interest. There's a slight bit of risk more so than you would find with your cash investments, but less risk with bonds than you would find as opposed to maybe stocks. Fast forwarding to stocks, right? There's several different types of stocks out there. Stocks on average historically earn between 8 to 12%. There's different categories of stocks. You have large US companies, Apple, Google, Walmart, Facebook, Bank of America, McDonald's. Medium-sized US companies, could be a Key Bank or M&T Bank, locations all up and down the East Coast, but west of Ohio, nobody's ever heard of these banks. A small company, maybe Evans Bank. Regionally, maybe a National Fuel or a Cheesecake Factory. The smaller the company, the more room for growth, the more money an investor can make on them, but the riskier they're going to be along the way. International companies, to clarify, these are your safer international companies. These are your companies like a Nabisco or a Burger King or a Toyota. They're headquartered in developed countries versus emerging markets, which are going to be companies that are housed in more of your developing nations, more your emerging nations, such as Brazil, Russia, India, China. Taking it a step further, stocks are broken up into subcategories, growth or value. Growth companies are companies that as they earn money, they take that money, they put it back into research and development, they take it and put it back into buying other companies, and the goal is to grow the company exponentially year over year. Versus value companies, they're not designed to grow. They're designed to generally pay out a monthly or in some cases quarterly interest, what we call a dividend, back to the shareholders. So value companies fluctuate less typically, especially during volatile times. As people approach retirement, they tend to favor the value companies as they tend to pay out, again, a steady stream of income to help provide an income supplement for people. So there's so many things. So where do we start to kind of, pull this all together and wrap up? Accessing your current picture. So taking a step back, doing this on your own is fine. It's great. But almost always having a financial coach to lead you down the path to help you understand what should you be looking at, what shouldn't you be, what's relevant, what's not. The first starting point is, in my opinion, always going to be seeking out somebody professionally in the field who can help assess your situation. And then we want to look at, again, protecting loved ones, right? Who in our life would stand to lose out financially in the event something happened? Reducing consumer debt, right? Looking at it and saying some debts will dissolve if we were to pass away, but some debts are going to pass on to our loved ones, right? Knowing the differences and what would they be burdened with. Making sure we pay yourself first. So societal wise, we live very much in a spend first, save second society. Flipping the script on that and saying, how do we save money on taxes? How do we pay Uncle Sam less and save more towards ourselves? How do we make sure we're putting money towards ourselves so that we have money now, not only today to live off of, but in the future? How do we balance that juggling act? Kind of talked about this already, working with a professional to get started, and then reviewing and fine tuning your strategy. There is no perfect situation where we can put a plan in place for somebody, or you can put a plan in place for yourself and have that plan hold steady and true for 20 to 30 years. First of all, life would be very boring if that was the case, right? Life throws us curveballs. Sometimes they're good curveballs. Sometimes, unfortunately, they're not so good curveballs. But nonetheless, we need to be able to adapt. We need to be able to pivot with those curveballs and making sure that we have a plan to review and to fine-tune those strategies along the way are arguably one of the most important parts of the plan. So we are at 12:29 here. With that said, this last screen I'm going to share, again, just my contact information, also has the QR code there. But at this point, I will turn it over to anybody that has questions, and I'll look at the chat for a few minutes too to see if anything was listed in there. And Lachey, I'll turn it over to you too as we're browsing this, if there's anything that you wanted to add or facilitate.
Yes, it looks like there's one question in the chat.
I'm looking at that right now. Back to sharing the screen 1 second here, sorry. So is it harder for older people to qualify for insurance? Do insurance companies require medical evaluations for all new policies? Okay, so great question. This is going to be insurance company specific. So what I will say is that insurance overall, life insurance looks at a few factors. They look at somebody's overall age, they look at somebody's overall health, and they look at the amount of insurance that we're applying for. So 100%, those are factors that are taken into consideration. However, every insurance company is going to look at things differently. Some insurance companies tend to be a little bit more conservative, and they only want to offer insurance to marathon runners. Other insurance company will look at things and, and they'll say, okay, well, if somebody is maybe closer to retirement, but they are, in good health and they're, they don't have very many pre-existing conditions, or their doctor's records show that they're taking any medications to help mitigate any type of ailments that they might have, then they would still go ahead and offer affordable insurance to that individual. So it's very hard to give a specific answer without getting into details about medical background, which clearly we're not going to do, in this forum. But I would say that it is not necessarily harder for somebody to get insurance as they get closer to retirement. It may be slightly harder if there are several pre-existing conditions, but again, the nice part is, at least from Equitable, from our standpoint, we are able to shop out insurance through about 50 different companies. So even if it's something that Equitable doesn't normally work with, we can go through a MetLife or a Prudential, or several other William Penn, many other insurance companies out there to see what their view are, or what their policies are to providing insurance based off of specific age is or specific credentials. And some insurances won't even require you to have a medical exam. More and more insurance companies, if somebody is under the age of 50 and they are relatively in good health, they will actually just look at your doctor's records and they will make a decision based off of that. They will not require you to have any type of medical evaluation done. But again, it's case specific. That is the only question that I see. So another 30 seconds or so to see if anybody else had any additional questions. It would appear that we are good for now. So Lachey, I'll turn it back to you. And Lachey, I want to thank you again, as always, for having us on these calls. There's a lot of information to throw at people in 25, 30 minutes. So, I know some of these topics are a little bit, we go through them relatively quickly. But again, if anybody has follow-up questions, personal questions, one-on-one questions regarding insurances, financial planning, their 403(b), investing in general, feel free to scan the QR code, reach out to me, or reach out to another financial professional that you currently work with. But thank you again. Everybody have a wonderful weekend.
Thanks, Nick. And this will be posted on the SAANYS page if you guys want to watch this again, right on SAANYS YouTube channel. Thank you. Have a great day.